This is Michael Fox, and this is the Prospector News Podcast. And joining me, I have longtime friend, first-time guest, David Erfle of the Junior Minor Junkie. Welcome, David.
Thanks a lot, Mike. Thanks for having me on.
For our listeners, David is an expert in the precious metals markets, predominantly gold and silver, and he's a big follower of the GDX and the GDXJ. This is going to be the first of where we get together at the end of each month and we talk about those markets and where they're going. It also will include the silver market, so that will be the SIL and the SILV. So David, we've been in a box pattern for both gold and silver for months and months and months on end. What do you take of this?
Well, make that 3 years, not months, but yeah, it's been a wild and crazy ride. Gold has really held up well considering what's happening with interest rates. When the gold price went over $2,000 for the first time in history, almost 3 years ago. The dollar index was around 90. The DXY was around 94. Now it's considerably higher, around 102, and the gold price is only a couple $100 away from all-time highs. But it's been really interesting. It's been grinding, and it's been opportunistic if you have a lot of cash and a lot of patience and you like to speculate in quality junior stocks.
Yeah, and patience absolutely has to be a virtue because we keep getting fake outs to the upside, fake outs to the downside. The other thing that's been puzzling me is the silver market. Last time gold was up around this level, silver was up around the $45-50 mark, and we're not seeing silver kind of following its golden cousin upwards as rapidly. Any reason for why? And is it just we're pulling back on the slingshot and looking for silver to take off?
Yeah, well, I think silver is a little more pressured by a higher dollar than the gold price is, because if you see a pop in the dollar go up for geopolitical reasons, you see the gold price go up along with it. The last time we tested 2,000 before this, $2,000 an ounce before this recent test, both the dollar and gold went up at the same time as a safe haven, and the silver price went down. And also, I think silver is a lot more of an industrial component than it was 10 years ago during the last bull market. So I think silver is almost not even a precious metal anymore. It does rise with the price of gold when the gold price does break out, but when the gold price is consolidating, like it's been doing for the past 3 years, the silver price tends to lag, and that's what's happening. The number to watch on that gold silver ratio is 80-1 now. Once it gets above it, starts trending above it, that's bearish for the entire sector, because the silver price and the miners tend to move together. And when they show relative strength to the gold price, that's bullish. And when they show relative weakness to the gold price, that's bearish. That gold silver ratio is around 83 right now. It needs to get back down below 80 and start trending below 80 to get more interest back into the silver space.
And that's the historical look at it. But as you mentioned, silver's starting to move towards being more of an industrial metal than it is a precious metal. Is the gold silver ratio even relevant anymore, or should we be looking at the ratio between, say, silver and copper, which is the king of the industrial metals?
Yeah, silver does tend to move with copper, and interestingly enough, it also tends to move with the sugar price. But as far as the gold silver ratio, I still think that's relevant. I still watch it very closely. But as far as silver is concerned, it's recently had very bullishly low sentiment readings. The daily sentiment index got into the single digits last week, and that's usually is an indication that it's going to turn around, and it looks like it has. It's starting to lead the gold price higher here, while the miners began to lead the gold price just on Thursday after gold tested 1900 into intraday and had a reversal on Thursday. That 1900 level is pretty significant on the gold price. It's basically the top of the previous breakout channel and also the 38.2 Fibonacci retracement from the recent $465 move off the lows reached in at the end of 2022. We basically had a triple bottom after a false move down in the gold price. Whenever you have a false breakout, especially in the gold market, you have a strong move in its original intention, which is the opposite direction. And that's what we saw when we had the gold price lose 1675 last year. And we had analysts, we had uh, even bullish, gold analysts, long-term gold analysts coming out and saying that the gold price, now that it's lost 1675, it's going to run the stops and it's going to go down to $1,400, $1,500. Well, that obviously didn't happen, and we had a triple bottom at 1620, and we had a slingshot move of $465 in the opposite direction to go up and nearly test the all-time high at 2089. It stopped $4 short of that, and stopping $4 short of that was for the third time gold attempted to break out of that $2,100 resistance level, which has been resistance for over 12 years. So, and a third test usually fails, and that's what happened. And now you're having a false move in the opposite direction again, I believe. And there's a good chance that the correction ended here at 1900. But we need to see gold price get back over $2,000 before we can get confident that the gold price is going to finally break out above $2,100 on a monthly basis, which would be which would signify a technical breakout of the gold price.
Is it possible, though, the gold could still remain in the box for another testing of the bottom and the top again?
Anything's possible in the gold market. You know, you never rule anything out. But if you take a look at the macroeconomics, if you take a look at the geopolitical situation, I think the gold price is ready to break out here. Like I said, you know, it's three strikes, and then the third try usually fails, and then the fourth attempt is usually successful in markets when you have a strong resistance level for that long. And the gold price did this at $1,000, but it only consolidated for a year. We had that false move once the gold price reached $1,000. We had that false move in 2008, where it got down to 600 to the low 600s before we had a slingshot move to the upside, and it didn't stop climbing until it reached over 1900 a few years later. So this base is even stronger because it's a 3-year base, and also there's a very bullish cup and handle pattern on the chart. If you take a step back and look at a 20-year chart of the gold price, it's got a very bullish 12-year cup and handle on it, and the handle has been taking place over the past 3 years, and once that breaks out, you have Fibonacci readings above that of over 20 of close to 2,500 and $3,300 an ounce. So once we have that monthly close above 2,100, that would signify a breakout. You'd have momentum traders coming in. You'd have a lot of power built up in the gold market to go a lot higher.
And given that and the gold silver ratio, is this likely to pull its silver cousin along with it, and possibly more rapidly given the ratio is as high as it is right now?
I believe so, because usually silver outperforms the gold price by a considerable amount. I mean, the most money I've made in this sector over the past 20 years has been in select silver stocks, but there's very few quality ones, and you have to get a hold of the right ones early and hold on for the ride. But it's very difficult to do. especially in the silver space because it's extremely volatile. You know, gold's volatile enough, but silver is extremely volatile. So you just have to make sure you have to be in the right companies.
Definitely. Now, moving on to the companies, gold has been, in this high box, but the miners themselves don't seem to be following. The GDX and the GDXJ have been steadily ticking down lower and lower here after its short little upward run in the spring. Is this seasonality or is there something else at play?
Well, actually, it's very interesting. If you take a look at the gold stock cycle going back to the beginning of the secular bull, it started when the gold price double bottomed at $250 an ounce back at the turn of the century. Gold stocks bottom every 7 years. We had a major bottom in 2001. Then we had a major bottom in 2008 during the global financial crisis, and then we had another major bottom in late 2015 after the bear market that followed the decade-long bull market in the gold price, and then we had another major bottom in September of last year. I know it's hard to believe if you're a junior investor, but if you take a look at the GDX and the GDXJ, they're still trading 40% above their lows reached in September of 2022. They've made higher highs and higher lows. But if you take a look at even the best of the best juniors, they continue to be sold because if you take a look at the gold price, it's gone pretty much sideways to nowhere. And the stock market continues to go higher. And I don't think this is going to turn around until a few things happen, until the gold price makes a breakout above that $2,100 monthly close and the stock market rolls over. Because basically, you've once the gold price lost 1550 back in 2013 and ushered in a bear market after a decade-long bull market, the generalist investor left this market and has not returned. So they've been out of this sector for the past decade. And so ever since the major bottom reached in gold stocks in late 2015, we basically had a couple of 6-month bull markets in the precious metal stocks, followed by 3-year bear markets. And we've reached the end of the 3-year bear market in gold stocks, but it has yet to trickle down to the juniors.
Okay. Now, on the silver side of things, what's going to be more important, that gold breakout or the move towards green technology and the increased industrial demand on the silver?
Oh, it's going to be the gold breakout for sure because basically, this sector is hated right now. And if you just take a look at the volume, look at the volume in the TSX and the venture. The volume hasn't been this low since gold double bottomed at 250 over 20 years ago. The volume continues to drift lower and lower and lower. We have some volume spikes recently on the moves higher in GDX and GDXJ, but when we see the correction from those moves higher, it's always on lower volume. This is a good sign because basically, the old adage "never sell a dull market" certainly applies to the gold market. The gold stock market. It's incredible if you take a step back and you look at the big picture on the gold price. It's got this incredibly bullish cup and handle pattern that's about to break out, but you wouldn't know it when you look at the gold stocks. They continue to lag, especially the juniors. These juniors, which were a lot of them were being bought out by majors during the past cycle in 2010, 2011 at over $1,000 an ounce on the ground. And now they're trading on average at less than $40 an ounce on the ground, while the gold price is even higher than it was back when the previous bull market ended in gold around the 1900 level.
Yeah, I keep looking at all these ratios and I just keep seeing a disconnect to it. I was laughing gently to myself when you said look at the volume. I was thinking, well, I tried to look at the volume. My telescope isn't that
You can't
powerful.
find it. Exactly.
But I am looking at Fed policy as well, and we've had some discussions with common colleague Chris temple of the national investor, and I start to see pressures coming on to the U.S. dollar if the Fed continues to remain stagnant at the current interest rates, given that the rest of the Western world is starting to to raise their interest rates again. Is that going to be the cause for the gold breakout, or are we looking at some other catalyst to get the gold market moving? Because what I'm hearing you tell me is that the key to all this is the gold market has to move.
Absolutely. Yes, we need that breakout. And as far as a catalyst is concerned, I think it could be macroeconomic or it could be geopolitical. I mean, we don't want it to be geopolitical, because whenever we have a strong gold move on geopolitical reasons, everything gets sold. Gold stocks, could go even lower, believe it or not, initially, while the gold price goes higher. And also, if you have a geopolitical catalyst, it can turn into a blow off move where you have a sharp move to the downside after it's finished. I mean, if you take a look at what it took place during the 70s bull market in gold, the Federal Reserve was beginning to raise rates in 1975 from the 4% level after the gold price had moved from $200 down to $100. It was cut in half after Nixon took the U.S. off the gold standard. It popped from 35 to 200, which is a huge move, obviously. And once that move was consolidated, when it was cut in half, it got down to about $105. The Fed started to raise rates, but the reason why they started to raise rates aggressively is because the market realized they'd lost control of inflation. Stagflation had set in. So the gold price went higher along with interest rates as Paul Volcker raised interest rates from 4% to 20% by January of 1980. But in late 1979, the gold price had only gotten to about 400 from 100. And what took the gold price from 400 to 850 by January was a combination of Russia going into Afghanistan and the Iran hostage crisis. So that was a blow off move and a bear market that ensued for over 20 years afterwards in the gold price. I don't see if a geopolitical catalyst is the reason for the gold price popping higher here. I mean, I don't see it ushering in another 20-year bear market. I see it beginning another bull market because you've also got the macroeconomic situation on top of this going on, where the Federal Reserve, each time that they raise rates, that it follows the Fed funds rate usually has followed the 2-year Treasury yield. And if you take a look at the 2-year Treasury yield right now, it's getting dangerously close to that 5% level again. In 2008, when the Fed was raising rates, the 2-year yield got to 5%, and as soon as it got to 5%, it ushered in the global financial crisis. And then the last time we had the 2-year yield get to 5% was recently in early March of this year when I saw you at PDAC, and the 2-year Treasury yield got to 5%, and that triggered the regional banking crisis. And it's at 4.87 now, and it's getting dangerously close to that 5%. So if it gets to 5% again, it could easily trigger more regional bank failures in the United States, which would trigger a gold stock move, a gold price move to the upside, and the stocks would follow. Because if you take a look at the GDX and the GDXJ, they gapped up when that took place back in early March. And if you take a look at the GDXJ, the SILJ, and the SIL silver ETFs, they have all filled that gap. The GDX has not filled that gap yet. It tried to earlier this week, but it still hasn't filled that gap. We're seeing a strong bounce here, but it's created another higher low in the gold stocks. And if gold has indeed bottomed here at this 1900 level, then I believe the bottom is in right at least a short-term bottom is in right now in the gold stocks.
So barring a shock to the system, such as geopolitical or the treasury getting up above 5 again, here in the summer months, is there, the usual seasonality to start looking again in August? Is that going to be at play, or should people be looking at what they're doing now?
Well, typically, as far as juniors are concerned, June, July time period is a great time to accumulate quality juniors, and late December after tax loss sellings in the middle of tax loss selling. And also what happens is Van Eck rebalances, which we just had recently, a couple of weeks ago. Both GDXJ and SILJ saw some strong selling, especially SILJ, in the quality silver stocks that are in those ETFs. The gold price and the silver price had been trading sideways. Gold was trying to hold that 1950 level. Yet you saw quality juniors. Some of them, some of the silver quality juniors have these fishing line sell-offs come out of nowhere, and that was Van Eck doing their GDXJ and SILJ rebalances. They're going to do these now every 2 years. I mean, every quarter, every bi-quarter. So every June and every December now they're going to do these rebalances, and they usually take place, start to take place a few weeks or the last week of the quarter. This time they took place a few weeks before the end of this first half of the year. And if you take a look at some of these juniors, the bottom 20 juniors in SILJ, a lot of them were whacked pretty hard, presenting incredible opportunities for patient speculators to get these things real cheap and hold on for the ride. Because, this is the way you have to do business in this sector if you want to make money. You have to buy fishing lines and sell rhino horns. You can't chase stocks, especially while the juniors have basically been in a bear market for the past 10 years. You can't chase price, because if you chase price, you're going to be selling for tax loss, and you're going to be out of this sector pretty quick.
Yeah, it's this sector likes to throw people off the boat pretty fast. So let's wrap that up for this month there. I look forward to talking to you again at the end of July, and thank you for agreeing to become a regular guest on our podcast.
Looking forward to the next chat, Mike. Thanks for having me on.
Thank you, David. The Prospector News Podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.